welcome, of course, on behalf of the ICCE, all of you to this lecture. And ICCE has been it's a new organization and relatively about 2 years, I suppose, Paul, 2 years. And growing, but the ICC has made a huge impact, I think, considering even the very small period. And in terms of the number of enrollment, number of activities, regional collaborations, and particularly in Africa, and the young economist, it has already onboarded. And this year we would have the second Young Economist Award. Paul, I'm sure we must be now getting ready.
Yes.
So I think congratulations and thank you, Paul, and all the members of the board and the Board of Studies, Governing Council. So over to you, Paul.
Yeah, sure. So basically, we go with the flow. It's going to be conversational. So, Prof is the moderator, so you ask questions, and any follow-up question you ask. If there's any other thoughts that you'd like to share, which might not be directly into the question, but it's relevant to the discussion, of course, you can also bring it up. And we're hoping that we can get questions from audience as they join as well. So we'll give them the chance to send in questions by the Q&A button as well. So that I will also be helping read out the question to Paul, and then you'll be able to moderate that session as well. So give or take, as you mentioned, within 45 to 60 minutes, we should be done from here. Yeah.
Sure. So to set the ball rolling, I think what we intend to talk about, I think Sarah is joining. So welcome. Let's welcome her. Yes, welcome, Sarah.
Hi, good morning and afternoon, everyone.
Yes, and you have to soon tell us in India good night, because we're almost getting
Oh, you're in India. Yeah, good night, sir.
And I'm sure the Indian participants would have all gone for dinner or they've broken for the day. And some of the Asians must have gone to sleep. But I think this would be a session available in YouTube. I'm sure a lot of interest would be there. So I think we have a very interesting session today, and we have excellent two speakers. Karen Harris, Managing Director, Macro Trends, Ben & Company, and Karen is a graduate of business from Harvard Business School. And then we have Shara Dejari, external member, Impact Investment Committee at the Sanitation and Hygiene Fund. She is a master from Imperial College London and has done courses on fintech from Oxford University, a said business school. So we're delighted and glad that you have joined us and you made us proud, the ICCE. And we really need your support to grow. And I just began introducing that the ICCE is just a 2-year organization, but has made a lot of progress in terms of enrollment, Young Economist certification, and also we have recognized the Young Economist. So thank you all. So let's set the ball rolling, and both of you are experts in your own way. But in the subjects that we are talking about today, the global financial market and specifically the financial architecture, and that is to meet the challenges in future in terms of adapting to new and emerging challenges, particularly in the ESG framework, investment, impact investing. So the key focus, though, is environmental sustainability, social and economic issues. But we are, since this is one lecture session where we discuss the global trends, so we also put a macro overview, country-specific dimensions that I think that would provide a backdrop. So let me start with Karen. You have an extensive experience, including the World Economic Forum and the Council on Foreign Relations. So first, a bit on very broadly the global macroeconomic trends, and also to an extent the geopolitics, which has been predominantly influencing the contemporary policies and markets. Over to you, Karen.
Thank you, and thank you so much for welcoming us here today. You've missed two very important items of Sarah's background. One is that she's a nuclear physicist, which makes her smarter than the rest of us put together. So we need to make sure she has plenty of time to speak. And the other is that she's a Bain alum in her secret past. So we have a confluence of us here today on this panel. When I think about the challenges of environmental sustainability around this conference, I think what strikes me is that the world faces a dual challenge, and there are major unresolved tensions in the energy and natural resource transition between cost and carbon in particular, as the world faces this dual challenge of expanding energy access while limiting global warming. I mean, if we just think about it, and I think Pradhan, you sit in India, which is in many respects at the nexus of this challenge. Quality of life, economic growth require energy. Affordability, access, and security are essential issues. If we think about the world today, there are almost 800 million people who are in energy poverty. Energy is essential for food security, for agricultural yields. And we can see, interestingly enough, as we've seen since the Russian invasion of Ukraine, all over the world, in times of energy security or energy insecurity, we fall back on coal. And so there's that tension there, and that is not meant with any criticism. I think it's a valid concern, often leveled at advanced economies, that development can't be like a game of musical chairs, that the music stops and we pull the chair out just as markets are coming up on their own phase of really improving the lives of their citizens, the way we saw, for example, China accomplish that over the last few decades. At the same time, the world is not on track for net zero 2050 or anywhere close to it. So accelerating climate degradation is likely, with significant damage to people, businesses, economies, and ecosystems. And this challenge is very different. I think you mentioned geopolitics, and obviously we see a new global interaction emerging that does not look like what we've seen since World War II, one that's more multipolar. But within this particular field, we see the challenge being different for different countries. If you're a low-income developing country, the primary question is, how do we lift countries out of energy poverty in a low-carbon way without erecting barriers to economic development, which definitionally means not following the previous trajectory of advanced economies, which worked pretty well for a lot of them, if you take the externalities out, which of course we can't. For emerging economies, how do we support those countries in industrialization? I think about India as one of these, without and accessing low-cost clean energy. And for advanced economies, how do we reduce emissions while maintaining high quality of life and growth? Although I know growth has come under fire as a concept. Personally, I believe that economic growth is important for national health. I mean, I think we've seen actually in COVID, for even mental health, that human beings need to feel as if they are contributing to society. And so, of course, population growth is overwhelmingly concentrated in regions that have lower energy consumption today. So almost definitionally, we will see that growth, and advanced economies will need to replace workers with automation in order to sustain their growth, and that makes them more energy intensive. And so we see this tension emerging. That doesn't make it insolvable, but the last point I'll make is the geopolitics of the moment are not towards effective multilateral institutions, and we can deplore that or we can applaud that, but I think observationally, the institutions, the multilateral institutions that were created in the wake of World War II have not been getting A's on their report cards in terms of effectiveness, well-meaning, sure. And therefore, we should expect to see a world that is more multi-speed, more disaggregated, and we need to think about how we can optimize outcomes in that world, I think, rather than bemoaning a world that I think is fading.
Yeah, excellent. Yeah, so what I'm trying to see here before I turn to Sarah, see, one of the very critical issue that comes here, for example, India or elsewhere in the emerging low-income economies, is the challenges of the making a transition to low carbon or that kind of sustainable, environmentally sustainable policies, and the cost is quite significant. And how soon or how effectively these economies would be able to make a transition to that, and I think that is extremely critical. And particularly in these economies are very high, as you rightly said, the high energy consumption economies. I think there are hardly any innovations that happen for long in many areas, and including the energy savings and in the carbon. So therefore, how will the government, there will be a lot of fiscal pressures, there will be a lot of budgetary pressures, and there are external funding. I'm not sure how tied or available to these energy saving innovations and devices or path. And given even the overall funding constraints of these countries, external capital, that is, so how do you channel this towards the energy? So there are two aspects which I think we might come in, and one is that the funding, the budgetary, and the availability of multilateral resources, very importantly. And the other thing is that we have also seen that many of these economies, the public debt is growing huge post-COVID world, and some of them even external debt, and how much they can bring in even in these areas. That is one area. The second is how the government will design interventions, regulations, or incentivize private sector to come on their own, bring in. And so I think these are areas that we might discuss. Now, thank you very much for your opening statements. Very interesting. So let me now turn to Sarah. Now, while you would keep this in your discussions, but also bring in the side of impact investing, that you have done a lot of work in that area.
Yes, thank you very much for the invitation, and thank you for bringing this question. And indeed, as Karen did mention just earlier, we don't have a lot of time, and according to the latest IPCC report, if I'm not mistaken, the world needs to increase green investments by 3 to 6 times compared to current levels in order to potentially limit global temperature rise to 1.5 and avert runaway and catastrophic climate change. And of course, this is more than all the grant making and public sector money that you and Karen were alluding to, that the world can achieve by itself. Therefore, to reach such a scale of investment, we need to address the flow of capital across the entire global financial system, away from fossil fuels and towards more effective climate solutions, biodiversity, nature, and generally a just transition to ensure that, if at all possible, we can all try and attempt to remain at the same speed, even if, as Karen has already alluded, a multi-speed world is likely what's going to emerge. We only have a few years left, and therefore part of the question is, if we agree on the diagnosis, obviously part of the question is, do we really have a choice? Can we afford to be a multi-speed, multi-spots world? We thought we did until now. Today, it seems less and less likely, considering that we're all in the same boat and we've built interdependency that has increased over the past decades. And we could say that luckily, to some extent, some movement have started when you're looking at sustainability. And to come back to your question, sustainability factors have become important, if not at times critical considerations for investors globally. And as companies increasingly embrace suitable practices, the role of asset managers in general, and here I'm thinking commercial private asset managers, their role is evolving to meet the demand of an increasingly socially conscious market, or at least this is what we could hope for. Obviously, then comes the how. How do we embark and how do we use our individual capital to try and answer some of the challenges you both have highlighted? Well, very obviously, it depends on where you are positioned on the capital stack. Starting with the obvious, if you have concessionary funding, first, obviously, we should highlight that you don't need to have billions or even the necessary trillions to start deploying your money and make an impact. Millions have the power to trigger the billions and potentially the trillions, and a relatively small amount of public sector money or philanthropic funding has the power to catalyze much larger amounts, but also much needed private capital, provided we can demonstrate that products that are piloted, tested, can solve the problem or some of the world problem and offer a commercially viable investment proposition for the capital at large. Hence, an option, if you have concessionary funding, is to intentionally test and pilot solutions with the hope to create this demonstration effect I've just mentioned, and to reassure commercial capital owners and allocators that the risk-adjusted return they can take is palatable, and therefore we should hope and do our best attempt to crowd them in so that they can play the role of scaling up solutions, but once they've been demonstrated, while at the same time pricing the risk accordingly. It often requires embarking the most audacious mainstream investors to start with into those pilots that I've mentioned, into blended structures, by providing some form of first loss capital to incentivize the commercial investors to accompany or to join the adventure into impact vehicles. And so, of course, blended finance, I'm assuming most of us understand those terms, but as a reminder, the blended finance is the use of catalytic capital from the public or philanthropic sources to increase the private sector investment in sustainable development, to direct investment into where it didn't flow before. So the blended approach essentially aims at reducing the financing gap by attracting additional capital and promoting the resilience that you both were alluding to earlier. They can also, those who have been in philanthropy for a long time, aside from the capital, they can also provide their expertise, past experience as philanthropic investor or grant funders, and they can ensure that some of the mistakes that have been already, or some of the lessons, I should say, that have already been learned by the sector are generally made public and to the knowledge of those that are new to the impact investment space. So in conclusion, for those who have catalytic money, it's obvious, but I think there's been already the past decade, we've started to see more and more such blended structures where public and private money do no longer work in silos. So this is all fine, but as I've said earlier, the concessionary funding is still very small in nature, and the vast majority of money is commercial money, and this is where there's the most money, and therefore this is critical to ensure that the private sector role is well laid out, because it is critical. So if we're only taking one, I just want to give one data point for the audience. If you're taking the UK as an example, the majority of investors, whether they're retail or institutional, say they are interested in investing sustainably generally. Yet out of the 10 trillions of pounds managed by UK investment managers, only short of 90 billion is placed with responsible investment funds. So that means it's less than 1%. And you could question why. If there's an intention, why is it not happening? How is it not deployed according to investors' so-called desire? But of course, there's a concern first on performance. There's a concern that sustainable investments will generate lower returns. And I'll come back to that later if I have time. It's sometimes true indeed, and there's a fallacy that there is no trade-off. Sometimes there's no trade-off, and sometimes there is a trade-off, and there's a need to accept a trade-off. Then there is the issue of trust, because there's generally been, even if we're progressing as a sector, there's been a lack of transparency and an increasing fear of greenwashing, as we've seen in the recent past. Third, there's generally poor advice. Most financial advisors have not been given. Most people with financial advisors have not been given a choice to invest sustainably for lack of training of those who are providing the advice. And quite the opposite, many financial advisors treat climate change as an issue that is still up for debate or that is at the fringe. And they're also ill-equipped, I would say, yes, ill-equipped or insufficiently trained on the issues and the risk that climate change itself is bringing into the mainstream investment strategies. And we see regulation changing on that. So again, there is hope. In my opinion, it's not moving fast enough, but we're starting to see regulatory frameworks and disclosures for more transparency. But we need the compliance teams to start putting advisors up when their files do not document appropriately climate risk in their conversations. So if we assume for a second that better trained advisors, better disclose climate risk and regulation will eventually fix that problem, we should see more transparency. And this is this transparency that is needed for private capital. And here I'm thinking commercial capital looking for risk-adjusted return to be able to make the decisions that it's not been able to make in the past. We've all heard about multiple frameworks, and I know there are still debates on which one will cross the final lines, and probably multiple. But the question should really be flipped on its head, and should be, why is it not sustainable for you as an investor to not invest sustainably, rather than why you should invest sustainably? Now, very concretely, and to finish that off, if you want to use your capital and invest it with impact, taking into consideration this climate financing and sustainability, financial inclusion that we've mentioned, there are, in my opinion, a few questions that you need to ask yourself. The first is which problem you're trying to solve with your money, because it will drive your due diligence. The second is, what satisfactory answers do you need to make an investment decision, because it will drive the reporting requirements, the KPIs, the measures that you want to see to make sure that the money that you're putting at work is creating the impact that you intended. And the third, in my opinion, is the role that either you as a direct investor or the asset manager that you choose to partner with and invest into is willing to play post-investment, because that will drive your engagement. And of course, you can partner with different type of players, and I'm happy to go into the details of each of these questions, how you answer or share my experience. I don't want to be predictive, but at least share my experience on how you can answer those three questions. I think I'll stop here for now.
Yeah, thank you. Thank you very much. In fact, I'm getting an impression listening to you and also reading globally the documents. I think ESG, climate, and sustainability issues are catching up faster in financial sector, possibly than the rest, or in the manufacturing or other sector. That maybe there are, there's something which I would like to get your comment. And when you talk of whether it is the green bonds or social impact bonds, or the financial institutions like banks having green portfolio, or the fund asset management industry, reporting, investing, identifying the ESG funds, or I think global size is almost touching. Bloomberg reported $7 trillion. The size of I don't know whether how is it classified, how accurate, and whether there are audit and compliance practices, or to really bring out these, whether they're truly sustainable and compatible funds, ESG compatible funds. But there are numbers which are coming out to be very significant, and then at the same time you also find that investors or shareholders are also reacting to ESG kind of issues in companies, and so I think we are getting an impression that the financial sector, this is catching up faster. Is it just an easy, or it's or that's where the lot of greenwashing or whatever, or because the corporate sector is somewhat slower. The real sector is somewhat slower. And if you have to tell me, I'll give you a specific example. Let's say coal, which is the highest carbon emissions, and most of the coal in India is public sector, is in the government, and I don't see much activity there as to the timeline. I mean, though there are on papers, but what are the policy interventions, regulations, and otherwise to neutralize the coal, which creates both as a public as well as private cost. It has a lot of health issues, and it has a lot of health hazards, the emissions, etc. And we're not very clear as to how long. So I will come back to say what are the alternative initiatives. But my point is that it's really catching up more faster in the financial sector. So therefore, I think I would turn to Karen now to get your views. What are your views on this shifting investors' preferences, or in the financial sector, how the preference towards the environmentally sensitive ESG or sustainable component of finance, both from the supply side as well as the demand side?
Right. Well, the supply side issue is complicated, and I see there's also a question from Jennifer about the pushback on ESG investing in parts of the world. Clearly, I sit in the United States, and that's the epicenter of some of that pushback. Many financial institutions are fiduciaries of their members' money, so they aren't making choices. If you're an asset manager, it's not, at least legally, your choice about where to invest. You need it's the owners of that capital who need to be making those decisions. And indeed, we've seen, and I think Sarah did a nice job of saying there are measurements to show that there are, in some sectors, not trade-offs, and certainly at the right price and right capital costs, there aren't trade-offs, but those haven't been used perhaps as assiduously as would be liked to make that argument more clear. I love the point that Sarah made about catalytic money and capital, because I think it really does anchor us on the pragmatic view. So I think about energy transition in parts of the world like sub-Saharan Africa, and some of the discussions remind me a little bit about telco. And there was breathless discussions about leapfrogging to mobile telephony, and obviously innovations like M-Pesa. That's fantastic. There is copper fiber that's needed up until, like, the untethering is not 100%. And the same will be true with energy transition. Right now, you need grid capacity because alternatives aren't consistent in their delivery, wind or solar, and that's fine. That's not a criticism of that transition path. It's just we need to be realistic that solar stoves are not going to be satisfying for the young population of 54 countries in sub-Saharan Africa, saying, wait, you get a smokeless stove, so hopefully your kids will be better off. This isn't a reasonable discussion. And so that I just wanted to appreciate that she had called that out so effectively. In terms of the demand side, there's been a lot of very positive progress in policy support at national levels, and that's increasing, particularly in developed markets. And I think in many respects that's a form of catalytic money, in the sense that if we can crack this problem where there's more willingness to pay, that creates technologies that can scale and be more accessible in other parts of the world. And just looking back over the last couple of years, we saw the infrastructure bill in the US, that was $1 trillion commitment to strengthen infrastructure against weather-related incidents. The Inflation Reduction Act, which was $400 billion committed to reducing the cost of clean energy projects. That's a great example of de-risking our first loss capital, as Sarah put it, and it's expected to reduce greenhouse gas emissions to 42% below 2005 levels by 2030, if implemented. New third-party estimates revealed that the Inflation Reduction Act may mobilize more than $1 trillion in government incentives, and $3 trillion in capital. So that, to me, we look to the places that are suffering the most sometimes in these discussions, but unlocking that in the United States will help drive the development. The CHIPS and Science Act committed $200 billion to US leadership in technologies. And looking at Europe, the EU Green Deal targets net zero by 2050 and 55% emissions abatements that focus on clean energy, biodiversity, food sustainability. CBAM launched in October 23 with levies on carbon-intensive products imported by the EU, and that's a different type of financial innovation. It's not seed capital, but it's a needed step in the direction of making externalities internal. Let's price in the full costs of some of the choices we're making. And the RED III directive mandating use case specific targets, carbon pricing, and so forth. And so I think we're seeing some important moves at a national level, particularly in advanced economies in Europe, the US, India. Has government efforts focused around subsidies and directed financing for low carbon tech. Australia, Japan. And so as we see these innovations, I think we see the initial overcoming the inertia with subsidies, tax abatements, and so forth. That creates the scalable opportunities in other parts of the world. So from a demand side, yes, of course, we could go faster, but I have to say I'm encouraged, even in what I see as a world where collaboration across borders is increasingly unrealistic, that in some core markets there are really encouraging moves. And this will be simultaneous. China is putting in place more coal capacity than the rest of the world together in planned, while also being a major producer of solar panels and wind turbines and so forth. So we're not going to get a clean story here. We never will. But I do think where we see catalytic capital, blended finance beginning to really have some impact is where it's backstopped by advanced economy government policies that make that de-risk that.
Excellent. Before I think I get Sarah's comments on what the broad pointers which Karen provided, but let me highlight just two brief things from India. I think the question also, Jennifer Roast, she talked about the big backlash. I think we have seen in India a lot of such activities by many non-market actors in this field. So they are quite whether it is from the civil society, the NGOs, the media, the community. I think there has been huge kind of backlash from these actors when it comes to the projects which have been undertaken by government. And so therefore, I think these are all critical areas coming up. I think this internally the government has to face and negotiate. And so I can give you a lot of examples, whether it is environment project or the river dam project or the electricity project, or even the copper plant in India. There are several of them have been. There's a huge protest from the civil society, NGOs, etc., and you are helpless in many ways. So that's kind of a backlash which is coming. But this other important point I thought to mention is that in India, there are a lot of activities which have been, the government has been. So I can just classify under 6 broad. One is the renewable energy, and I think India promises to reach the renewable energy by 2030. We also had extensive ban on plastics, but unfortunately has not been successful because a large part of small economies, small business, they actually depend on plastic. The production happens there, and the common man. So it has not been very successful. In the electric vehicle policy in India, very specifically, has been somewhat successful. It's moving very fast. And then we have alternate energy like green hydrogen, which is picking up. Many private sectors have come up. We have another very interesting area, which is called the scrappage policy. The old, used the electronics scrappage, or the old cars, the aged cars, all have been scrapped. I mean, these are all working progressing very well. And then, of course, when it comes to regulations, regulatory reporting, so the sustainability reporting is gaining quite significantly in India. We have the Securities and Exchange Board of India now coming out with what we call BRSR, Business Responsibility and Sustainability Reporting, mandatory for at least the top 1,000 companies. So some of the, and the audit and other processes are, I think, is gaining momentum. So what I can see is that India, both corporate sector, many of the top companies have already declared their ESG compliance by 2030, 2040. So almost a large number of companies have put. So there is on ground things are happening on paper, and people are moving. So, but as I said, there is a significant backlash from the non-market actors, which I think is gaining. Now, coming back to I think the Karen's points, and Sarah, would you like to comment on some of this, and then we can probably move into a little more broader issues. You are on mute.
Apologies. Do you mean commenting generally on impact investing?
Yes, yeah.
Yes. This is a tough conversation, in my opinion, because as I prudently allowed it to in my earlier response, there is indeed been some sort of a hype around impact investing about what it is, what it can deliver, and what it cannot deliver, at least on certain topics. So, starting very basic, if we're asking ourselves, what is indeed impact investing? This is investing in a business that creates an impact, preferentially with the intention to create the impact that it does create. So it means that it is investing in businesses for which profit is not the sole mission. It does not mean any investment in emerging markets, but put out simply, it means looking at the intentionality to create impact, or the theory of change, that also are terms that you might have heard of. Such examples could be, trying to tackle poverty, or at least poverty reduction, bridging the inequality gap with offering products and services that are affordable to those that are not yet served by the mainstream corporates. It also has encompassed more recently climate solutions, provided there are, again, tangible, measurable results. it's only going to be attractive to mainstream investors, and therefore we can only hope that those type of investments will scale at the scale we need to solve the multiple issues Karen mentioned earlier, only if they can compete with other investment options. And obviously, we all know that with high risks need to come high returns, according to the risk-adjusted returns that commercial investors will unavoidably, and given their fiduciary duty, will be looking for. So that requires transparency and measurement. And as we've mentioned earlier, there's hope that we're moving in the right direction, even if we're obviously not there yet. Impact investment if we're looking at impact investment, emerging market debt, and if you ask yourself, does it deliver risk-adjusted return, then despite the increased transparency, there is still an issue around comparing like for like with mainstream products on the selection ratios, whether you're looking at risks, maturity, repayment patterns, collateral, legal or even business recourses that you could have in case of default, refinancing risk at maturity, and obviously currency risk. So you have mentioned earlier, sir, that green bonds have proven to be attractive. Yes, and indeed that's true when you're looking at some of the Nordics, Norwegian green bond that have been very successful recently for for financing alternative sources of energy. Indeed, very successful, and there was no need, or almost no need, and in some cases no need at all for a risk absorption capital layer. Yet in emerging market, green bonds generally do need this layer of risk absorption, either because the systems are not in place, the regulations are not in place, the size of the transaction is very small and therefore too costly if you do not have some sort of concessionary money. So to the question, can impact investment become mainstream? I would say sometimes it is possible, and overall debt to finance the economic growth of relatively large, stable countries can be very compelling. And indeed, in my experience, I've seen great success in Mongolia, Vietnam, Kazakhstan, Egypt, Kenya, even Myanmar before the coup. So when you're financing the growth of the mid-size corporates, and when there is stability regulation for those sectors, indeed, you can have very compelling propositions even in emerging market and create the impact that you intended by delivering affordable access to products and services to those that did not have access to that before. And this is all in all growing the local economy and at the same time fighting inequalities. All of that is a great story. You can also find a great story when there's an improved economics in the business model, and this is technology. Typically, at least in my space, how the digitization can accelerate affordable access to financial services, for instance, whether it's for individual or MSMEs within their value chain, by leveraging, for instance, their digital footprint to create a credit score that you couldn't have before. I've typically seen that very successfully deployed, especially in India, but also in other regions where there is sufficient scale so that it's attractive for commercial investors, Indonesia, Nigeria, Egypt. Technology really has a power to change the economics, and fintech has been a great success in some of those countries. Payments also, to name another one. So indeed, you do have pockets where there is no trade-off between the impact you create and the returns, the risk-adjusted returns, that you can offer to mainstream commercial for-profit investors willing to also look at creating an impact with their capital. Now, there are also pockets, and I think we shouldn't kid ourselves and call a spade a spade. There are also other pockets where it's a lot more complicated. I've been working in equity investment, in impact investment, and when you're talking to mainstream investors who have this fiduciary duty that Karen alluded to, when you're already saying equity, your money is going to be locked for 10 to 12 years, no liquidity or very little secondary that can offer liquidity. You're taking a bet on the currency, you're taking a bet on the political regime, you're taking a bet on future regulation. And generally, it's difficult, for mainstream investors to be willing to part with their capital and honor their fiduciary duty as they should to invest in private equity in certain investment strategies in emerging markets, just only to create an impact. Or they need to invest very large amount of capital or invest in fund-of-fund structure. And both of these have the inconvenience to either have a double layer of management fees, which is expensive, or have the risk to dilute the capital or dilute the mission, because when you're investing $100 million ticket in a fund and you want to make sure you're no more than 10%, then all of a sudden you're talking very large funds. And those PE funds in impact investment who've been successful raise 1, 2, 3 funds. Generally, they're looking after large tickets. They've been upscaled. They've diversified across sector, but they've generally invested larger and larger ticket sizes so that they could manage the economics within a 2% management fees. So why am I saying all of that? It's that there is some sort of a fallacy that impact investment does not necessitate a trade-off. I think we need to be more realistic, more pragmatic, and that requires to be more nuanced and more transparent. There will always be a need for concessionary money in certain pockets. We're in difficult geographies, in very small states. And here I'm thinking, for instance, education, healthcare, access to water, but also agriculture, the regenerative agriculture, the transition to a low emission agriculture to ensure food security. This is still a very, very difficult sector. Humanitarian finance, innovative finance, all those terms you might have heard of, still necessitate that someone, and if not you as a commercial investor, if not you need someone else in the investment chain to come with concessionary money so that your return can be satisfactory. So if we want to offer commercial returns or risk-adjusted return to commercial investors, which is a necessity to scale the flow of capital into problems that have not yet been solved, you need this blended structure, and you need to allow for private money to piggyback on public money. And yes, it's very difficult, as Karen alluded, maybe in certain areas or geographies more and more complicated, but yet, do we have a choice? Really, do we really have a choice? It seems that we are living into an increasingly interdependent world, and there's intertwined challenges you've both alluded to, I think, that creates a new fragility in our world between poverty, climate, refugees, gender inequality, and 10 other issues I'm forgetting right now. Of course, the investment climate is increasingly complex. Climate change is making it increasingly complex, and yet we don't really have a choice. Chinese growth was a growth story, but it's slowing down. India is still growing, but the growth engine has slowed in the world and has sometimes reversed, even due to COVID or climate change. So we need more jobs for the younger generation, and we need to find new business models supported by the digitals right now, and not only for financial services, obviously. We need to make sure that education is suited for proper training. So all of that, without taking too much time, I think all of that is needed. And if not pure impact investment, those who've practiced like me impact investment for a long time want to see, then we need to invent new models where impact investors and commercial investors work in tandem despite the difficulty, because we might want, that's very a nice wish, to be willing to continue generate the risk-adjusted returns for everyone as we did in the past, and it did work well for most investors in the past. We might want or desire to continue with that strategy. It's not all that sure that's going to work any longer. So, as the CEO of the World Bank, I heard say in an interview, done is better than perfect in our times, and we really are running out of time.
Yes, perfection is always late. But thank you, sir. I think one point of yours which I really appreciate and is the role of agriculture. I would believe that the agriculture directly contributes positively contributes to green and climate related, and also more investment in agriculture can reduce a lot of negativity, particularly
Yeah.
sustainable use of natural resource,
Yeah.
land, flood control, and the controlling from droughts, and all of them can have a lot of positive impact, adverse impact. So I think more investment in agriculture. And unfortunately, if you see the trend, the agriculture sector is not attracting a lot of private investment. There is a reduction, the drastic fall in the share of agriculture in GDP, and the migration out of agricultural sector to the urban. What was agrarian poor is now becoming urban poor, and the rural population is primarily the old, and the young have migrated, old and unemployed, the agricultural sector. So I think that has its own challenges, but I think investment in agriculture would contribute directly and indirectly to what we are talking about. That's I think is a very interesting point which you made, and the second point I thought, I think there's a lot of research which has been done on what you mentioned about return side. I think the research has said that if I generalize, the companies perform better if they are complying more in terms of ESG matrices. And the more ESG integration into the process explicitly and systematically in the investment decisions, the performance are better. These companies are good, better governed, they're better managed, higher earnings per share. They do a lot of cost savings and use resources efficiently, and lowers the insurance premium. The companies who manage well the ESG factors, they really bring down the lot of insurance cost. We have seen that very well in many companies who work in disaster-prone areas or flood-affected areas. I'm sure that they bring down a lot of insurance cost if they are careful. So I think ESG impacts are visible. And so Karen, would you like to bring some points that you have been thinking to rather than me highlighting what you could speak?
I think as I reflect back on your comments, on Sarah's comments, walking away, I think the takeaway I would have from this panel is that we first, progress, not perfection, that there's a lot of reason that we've seen investments that work and don't work, that there are corners of the market that are going to be really challenging to address. And again, within an era of waning multilateralism and concessionary lending, those get more obscured, unfortunately, in the shadows. But that shouldn't stop us from looking at, on the margin, there are a lot of progress. We're so nascent in this journey of energy transition. I would argue that we haven't even found, with the technologies that our children will be using in 50 years are probably nothing like the ones, or maybe the distant relatives of the things we see today. And that's good. It means a disaggregated market, and multiple investments have lots of different opportunities for discovery. And so I think the takeaway I would have is the need for that the private sector is going to need some supportive, some catalytic capital. However, that's being provided already in some forms. It may not be hitting the areas of the market of greatest need, but at least it's progress, and hopefully will create its own acceleration. And again, as Sarah put it, crowding in if we can see sufficient scaling. And so maybe we need to distinguish the time horizons between the innovation period, which we're very much in now, and the scaling period, which tends to bring down costs and not despair. I think there's a lot of reason to be, there's a lot of interesting progress being made.
I think we are almost coming closer, but I am tempted to quote two great people in this domain. One is the Mahatma Gandhi, the Indian leader, and he did say a very interesting point. He said the world has enough for everyone's need, but not enough for everyone's greed. I think which is so important today, that in our greed to consume, in our greed to produce and exhaust natural resources, maximize profit without caring for our future, and I think they're extremely important today. And leaving to private sector, I'm sure that definitely becomes vicious. Though there is recognition, there is realizations, the private sectors are concerned, but I think still long way to go to bring that kind of a moral impact. So therefore, we need simultaneously regulations, both carrot and stick. And that said, and then one more I think Kofi Annan said once that the world is reaching the tipping point beyond which the climate change may become irreversible. If this happens, we risk denying present and future generations the right to a healthy and sustainable planet. The whole humanity stands to lose. I think it's so powerfully mentioned that I think it's everyone, whether it is government, civil society, corporations. I think this is obviously the age of corporations. So the companies have to realize this. And I remember the Paul Atkinson, who it's the British management consultants, who said that triple P, the planet, people, and profit. So we need to balance this triple P. And I think that becomes extremely important. So the role of private sector is definitely important, but the government has an overriding role. And so I think these are extremely critical issues in future. Sarah, would you like to comment before I ask both of you to give your final observation? Is there any point that you thought we haven't covered?
I think I like what Karen has said, and I think unfortunately we've not yet figured out sufficiently what are the models that work so that they can be scaled quickly, or quickly enough so that we never reach the unfortunate tipping point that you quoted Kofi Annan alluding to. We're still experimenting very much. Impact investment is still a very niche sector, very small, with messy reporting, overlapping or not always properly overlapping reporting templates and measurement. It's still very expensive. And I find it very hard, working in this space for 20 years to be solely positive, because experiments require the willingness and the pragmatism to realize that you sometimes will fail. And there are still a lot of experiments that need to be run. And I admire Karen's optimism. I'm sometimes not as optimistic, and I feel that we're running out of time and we are too few to try and be willing to experiment. And where I join Karen is the fact that the world is becoming a more multi-speed, and collaboration is increasingly more complicated, and we're looking at the multiple issues we're facing for the survival of our species. This is not a small ordeal, with generally with an egoistic point of view, very often times driven by the fiduciary duty that most of us have to work with, but we still only want to accept concessions according to my country, my model, my returns. And what I fear most is that we fail to realize to which extent we're all in this boat together, and that if we do not find common grounds for solutions at scale, climate doesn't care about our individual needs or desire for risk-adjusted returns. This is now we have a global issue that, in my opinion, can only be solved globally, despite the political, the macro-political, macro-geopolitical increasing issues we face. There is no way to give up. We cannot give up unless we accept this is the end. And I don't think any of us is willing to accept that. So we need to continue the fight. We need to continue experiment, and we need to continue develop this reducing our greed, as you mentioned earlier. So that would be my probably, what this conversation inspires me today. Thank you.
Thank you. Thank you. I think Jennifer also makes a comment. None of us is safe until all of us are safe. And excellent. Karen, would you like to make your concluding observation?
No, you know what, I concede. I think that was a perfect place to land, actually. A dash of hope and a dash of fear to inspire us.
Yeah, of course. But I think this is an evolving, and it came a little fast post-COVID world, the realization, and everybody geared up, but I think significant preparations have been made, at least preparedness happening all over, developing as well as developed economies. Multilateral institutions have to adopt quickly, put in more efforts, and I think that's an area where, if I say so, there's not much has happened in terms of. Am I right? That I can say the investment management industry has geared up even faster, but not much multilateral in what was expected. It probably could have been a little faster. So we look forward to more energy in this domain. And so thank you very much. And I now call upon Paul Paul, please. And thank you very much. It was nice evening, Karen and Sarah. Nice knowing you both. And thank you for your support to ICCE. Paul,
thank you very much. Thank you, Karen. Thank you, Sarah, for joining us for. Can you hear me? Am I audible?
Yes, we can hear you.
Okay, perfect. So we thank you all for making the time out of a busy schedule to be with us today as we began our day one of the GEIF, and we've come to the final, at the end of today's session for day one. We go again tomorrow for the day two and the final, last two sessions for GEIF 2023. And so for our participants that join us, we'll be coming your way again tomorrow with the last two sessions for GEIF 2023. We hope to see all of you there. So thank you all to our panelists and to Prof for moderating the session. Thank you.
Thank you. Namaste. Goodbye. Thank you.
Bye.